Hi, everyone. Welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Another big show for you this week, a lot to discuss. Today's show is brought to you by my friends at YCharts. YCharts is an awesome data analytics and charting platform. Take a look at the show notes for a link to a free trial to YCharts and 20% off when you first sign up for the service. So let's start out by talking about that huge employment report that we got last week. And it showed that the greatest jobs comeback in history, as I've been calling it, is finally complete. So what do I mean by that? Well, we had 22 million jobs lost in March and April of 2020 during the initial stages of the pandemic, the shutdowns, 22 million jobs lost. And since then, we've really been clawing our way back. And now we've added over 22 million jobs since then. And we hit a new high in terms of jobs in July. So an awesome thing to see. We've been talking about the reasons why this was likely to happen because we have just so many job openings in the US. So a lot of demand for labor and not enough supply. So if we looked at that spread we've been talking about between the number of job openings and the number of unemployed, it was at a record high of over 5 million. And so great news to see. Huge jobs beat. And in terms of the U.S. economy, this would be the thing you're going to point to if you're arguing that maybe we're not yet in a recession. So we'll talk more about that in a little bit. But let's first touch on the U.S. unemployment rate, which ticked down to 3.5% in July. That's the lowest we've seen since before the pandemic. So you have to go back to February 2020. We saw also 3.5% unemployment rate. And before that, you have to go all the way back here to 1969 to find a lower unemployment rate than 3.5%. So stunningly low number, stunningly strong jobs market. I don't think anyone in March and April of 2020 would have predicted that the jobs market would be this strong at this point in time. So great thing to see. Now, in terms of those factors that we're talking about, in terms of why I thought that we would see a new high in jobs this year. Well, they're starting to reverse, move in the other direction. So this is something to watch here. If we look at the number of job openings, we hit an all-time high of almost 12 million here in March. And since then, it's declined every single month. A pretty big drop off the last reading. It's at a 9-month low now, and I suspect this is going to continue in the coming months. We're starting to see, of course, businesses start to increase their layoffs. We're starting to see other signs of weakness in the labor market. If we look at jobless claims and new filings for unemployment here, which are rising, highest levels of the year. So the leading indicators of the job market suggest that there is weakness to come. When is it going to come? When is it going to show up in the payroll data? We don't know. But if this trend continues, we're likely to see a slowdown in terms of the labor market, which wouldn't be surprising given how strong it is. Of course, that can't persist forever. So in the meantime, there's still a lot of demand for workers in certain industries, but we're seeing, particularly in the technology space, increased announcements of layoffs. So we kind of have a bifurcated labor market here where in a number of industries, there's still a shortage of labor. And then other industries where it seems like they overhired and overinvested after the pandemic, and now they're pulling back from that. So we'll see how this plays out. But the big story, of course, I think is the recovery of the labor market and how quickly we recovered from those pandemic lows. So great thing to see there. In terms of inflation, this is something that I've talked about, but I think this is the most important chart in terms of what's going to drive the economy in the coming months. It's really the spread between the inflation rate, so the prices people are paying at 9.1%, and wage growth, which is down at 5.2%. So in any other time period, 5.2% would be incredible growth. You'd be celebrating that number all day long. The problem today, of course, is that high rate of inflation is more than eating into that. So there's just a big gap there. And what people spend the most on tends to be housing and shelter. And we're seeing persistent inflation there. If we look at the rental data from July that we got, we have an increase of 12% over the last year. That's still a very high number and well above the increase in wage growth. So The big question is, if we look at some of the spending numbers, how is the US consumer, how are Americans still maintaining their spending? Why hasn't spending collapsed if there's this huge gap in terms of the inflation rate and your wage growth? So there's two factors really supporting that for the time being. The first is the savings rate. So people are deciding to save less. So in order to maintain their spending, they're saving less of their income from their jobs. So we have the savings rate in the US down to 5.1%, which is the lowest we've seen since 2009. And the second factor is they're borrowing more. So consumer credit collapsed after the pandemic recession, but now it's starting to really accelerate here, up 7.7% over the last year. That's the highest rate of increase we've seen since 2011. So really, these two factors for now are allowing the U.S. consumer to maintain their spending if they so choose. So the question, of course, is when will they decide to pull back? When will they stop lowering their savings rate or increasing their credit, or be forced to and really slow down their spending? And I think that's the answer to that is coming in the next few months. So we'll watch these two indicators closely for any signs of a reversal. In terms of the recession here, this is a term, the double dip recession, that we haven't seen in over 40 years. People are talking about today. Why are they talking about it? We talked about it last week. We had that second consecutive quarter of GDP, negative GDP growth, which the last 10 times we've seen consecutive quarters of negative GDP, we've been in a recession. Now, not everyone's in agreement with that. If we look at quotes from Janet Yellen, Treasury Secretary, President Biden, and the Fed Chairman, Jerome Powell, over the past few weeks, all three saying that the U.S. economy is not in a recession. And they're pointing to those payroll numbers and the jobs market saying we can't be in a recession. But if you just look at the economic growth numbers, it really tells another story. As we've talked about, two consecutive quarters of negative GDP, and you have the situation where we've never seen a decline, a two-quarter decline in GDP growth in the U.S. of this magnitude without the U.S. being in a recession. So I guess it depends, of course, on how you define it. And the official arbiter in the U.S. is the NBER, and they have not yet declared the U.S. to be in a recession. We'll talk about next week. I'll talk about kind of the lag that the NBER has historically from the start of recession to their announcement. So it's not going to be immediate in terms of when they've recognized the U.S. economy to be in a recession. And of course, there's a possibility that we aren't yet in a recession, and that would delay it further. So there's no mathematical formula that the NBER uses to declare we're in a recession. So it's impossible to say when and if they're going to say we're in a recession. So we'll just have to wait and see. The employment numbers, again, would be the strongest case to say that we're not, but we're seeing weakness in many other areas of the economy that historically, when they've been at these levels, are indicative of a recession. And the big one that I've talked about that continues to push more negative is the spread between new orders and inventories in the ISM manufacturing report. It's down to -9. And so when you see inventories rise and new orders fall, and that spread really turned negative, that's been a recessionary indicator in the past. If we're looking at the 2020 recession or 08, 09, 1980, 1973, 75, the last four times we've seen this number this low, the U.S. economy was already in a recession. So again, odds go up based on these kinds of indicators. So if we are indeed in a recession, what would be different about this recession as compared to the last few? Well, it would be the expansion before it being much shorter. So let's say the economy peaked in January of this year. Well, then the expansion would only have been 21 months in duration. That's much shorter than the prior four expansions, which all lasted many, many years. And we had, of course, that longest expansion in history from 2009 to 2020 at 128 months. So this would be something very different. It would be more akin to the double dip recession we saw in the early 1980s, where we had this very short expansion followed by another recession. So there's some similarities, of course, with that period of time. That was a very high inflationary period. Fed was hiking interest rates, of course, much higher than today, but similar situation in terms of you had a very short expansion, and then you have a contraction in economic growth. Now, we haven't yet had the declaration that it's a recession, but if it were to be declared, this would be considered, I think, a double dip recession. And interesting thing, if we're looking at historical expansions and contractions, if we take the long-term average, so let's say since 1854, the average expansion's been around 41 months, average contraction or recession, 17 months in duration. But if we're looking at how this has moved over time, we've seen a maturation of the U.S. economy. So we're a much more diversified economy nowadays, much more resilient economy. And what we've seen is the result of that is we've seen longer economic expansions. So now if we're looking at the average since 1945, we've seen an average of 64 months in expansion and only 10 months in terms of a contraction. So longer expansions, shorter contractions has been the trend. So if we're in a recession, of course, if we look at the long-term historical average, would suggest it would last about a year and a half. But more recently, we've seen that really cut down. I think the extreme example, of course, happened in 2020, which was just a very short-lived 2-month contraction, but 10 months has been the average since 1945. So as we've talked about, stock market's a leading indicator of the economy, and if this downturn is attributed to a weakness in economic growth, the stock market's going to move up well in advance of when the economy starts to move up. So if the average contraction is 10 months, we could see the stock market moving up. Let's say this is a 10-month recession, it could be moving up well in advance of that 10 months. So just an interesting data point, something to think about as the recession debate rages on. And in terms of the recession, one more indicator I want to point out here, and we've talked about the yield curve, but really the question you have to ask yourself is this time different when you look at a chart like this? So we have one-year Treasury yields continuing to rise in the U.S. up to 3.29%. That's the highest since December 2007. And what that means in terms of the yield curve is you have a very inverted yield curve in terms of the spread between the 10-year and 1-year at negative 46 basis points. We haven't seen it that negative since November 2006, and before that in September 2000. So what's interesting about both of those time periods, of course, is they preceded recessions. So the economy peaked over here in December 2007, peaked in here in 2001, April 2001. And what you had was the U.S. economy entering recession and the Fed starting to cut interest rates again. So that's kind of what the Fed funds futures curve is portending here, and why this spread is this negative is because the market's anticipating the Fed to continue to hike rates over the next few meetings, but then start cutting rates. And that's why longer term interest rates are lower than the shorter term yields like the 1-year yield. So something to watch. The question for people saying a recession isn't coming, you have to say this time is different, that the yield curve today is not signaling a recession as it has in the past. So shifting gears, talking about the stock market, this is a question you hear a lot. Is the stock market overvalued, undervalued, or fairly valued? And we could debate what that means, but if we look at a table here of earnings and valuation, so looking at S&P 500 trailing 12-month earnings and PE ratios, interesting thing that we have here. So since 1989, the historical average trailing 12-month PE ratio is 19.6. And that, as Luxo would have it, we're exactly at 19.6 today in terms of the multiple. So if you're looking at that data point alone, you'd say, okay, the S&P is fairly valued. It's not above that as we were entering the year at 22.9. It's not below that. It's not undervalued as we've seen in 2018. And then before that, in 2012, 2011, significantly under the historical average. We're right at fair value. Now, the problem with that, of course, would be in terms of the denominator. So that that valuation relies on that E staying at that current level and not falling. And what you tend to see during recessions, of course, is that E starts to fall. You see a contraction in earnings, and we've already seen that where earnings have peaked in the U.S. The S&P earnings peaked in the fourth quarter of 2021. If we look at second quarter earnings, they're down 7% from that peak in the fourth quarter of last year. And if we look at year over year growth, we're down to around 1% in terms of the year over year rate of change of operating earnings in S&P 500 companies. So if we're in a recession, you'd expect this to continue. This would turn negative, and depending how deep the recession would drive how negative it's going to get. But that would be the pushback to say that stocks here are not fairly valued because that earnings level is going to fall. If you think that earnings are going to recover from here, go right back up, then you have the opposite situation where maybe if prices stay the same, the P ratio is going to fall, and you could say that stocks are cheap. So it's going to be much dependent on that. And of course, as we always talk about it with stock prices and earnings, stock prices are going to move first. And then you'll see the reaction in earnings. So if stocks continue to fall from here, it will likely portend lower earnings to come. So if in terms of the rally, where are we? Let's gauge the rally here. It's been a significant rally off the June lows. So we talked about here at the June lows that extreme oversold condition, extreme bearish sentiment. Really, nobody was expecting a rally. But if you looked at the historical data, the odds did suggest a bounce. We've had now a very nice bounce, even for a bear market here at 14.6%. But I think the interesting thing is people are still skeptical. So I put out another poll. I've been doing this every week or so, asking people if you think the low that we saw on June 17th will hold. And still 61% say no, that we're going to see lower lows ahead, that this is just a bear market rally. So very interesting to see. I suspect if we continue to rally, I think more people, of course, will be believers. And if we start moving back down, you're going to have even more people saying that it's going to be lower lows ahead. But interesting picture in terms of sentiment, where people are still, I think, pretty skeptical. I mean, they were burned, of course, by these couple of rallies if you bought into that being the low. So that's one factor. It's also the recessionary talk and the weakness in earnings, continued worries about inflation. So all of these things, I think, are weighing on investors to where they're not believing that the low is in just yet. So in terms of recovery, historical bear market recovery times, I put together this table here showing historically how long it's taken the S&P 500 to come back from a bear market drawdown. So if we look at 2020, it was very quick, right? 5 months to new highs. S&P had to rally 55% to recover from that loss. This time around, if the loss is only 25%, if that holds, you'll need around a 32% gain to get to new highs. And really the big question is, as we talked about with bear markets, is this going to be a short and sweet bear market or a long and deep bear market? We don't yet have the answer to that, but that will really dictate how long the recovery period is going to be, most likely. And so if we see another deeper, longer bear market like we saw from 07 to 09 and 2000 to 2002, that recovery period is going to be measured in terms of years and not months. So we took four years to recover from that March 2009 low to hit a new high again. S&P had to rally 136% to get to new high, and it took over 4 years to recover from that 2000 to 2002 bear market. So it's been a long time since investors have had a bear market in stocks that hasn't recovered in short order. So that would be something different. That would be a change for investors that they haven't seen in some time, but certainly not out of a historical perspective. We've seen many bear markets in history that have taken multiple years to recover those losses. So I want to end here, as I like to do, with a positive note. We started with a positive note in terms of the new highs in payrolls, so let's end with one as well. And there's a saying in the commodities market where they say the cure for high prices is high prices. And what they mean by that is if prices get high enough, two things tend to happen in terms of the commodities market. You tend to see an increase in supply. So production increases. People want to, people that are sellers of commodity want to benefit from those high prices, make more profits, more sales. So you'll tend to see supply increase eventually. And you'll also see at some point demand fall. So you'll see people pulling back from spending on that commodity if the prices go up too high, assuming that there's a substitute or something that they could do in terms of their behavior to pull back. And so we're seeing both of those factors really play out here in terms of the decline in crude oil and the decline in gasoline prices. So if we're looking at the supply side here, it doesn't look like much here, but from the lows in June, we've seen an increase in supply of almost 8 million barrels. So that's a pretty good increase in terms of supply. But more importantly, what we're seeing is gasoline demand start to fall. So as gas prices hit, $5 a gallon, you really started to see consumers change their behavior really for the first time in a long time. And I think this poll from AAA really tells an important story here, where 64% of Americans reported making changes to their driving habits or lifestyle because of higher gas prices. So driving less would be one way. You can combine your errands, reduce your shopping or dining out. So in any number of ways, people have changed their behavior. And what we've seen as a result of that is really demand fall. And an interesting stat was that if we look at gasoline demand, it's actually at its lowest level since July 2020. And what's interesting about that is you still had the COVID restrictions in place at that time, and people weren't traveling that much. So we've seen a pretty significant pullback in demand. We've seen a reasonable increase in supply. The combination of those two factors, but the demand side being more important, has led to the price of gasoline and crude oil really plummeting, which is certainly good news for everyone. And so we're down to $4.05 per gallon. That's about 96 cents below the all-time high that we saw in mid-June. So pretty big decline. I suspect we'll see prices below $4 in the next week or so, and then it'll be dependent on where the price of crude oil goes and these other factors. Does supply continue to increase? Does demand continue to fall, or does it rebound? But for now, we'll take these any declines we can get. This has been a huge factor, huge talking point, and to see gas prices now at their lowest levels in 5 months, it's a welcoming sign for most Americans. So that's it for this week. Thanks everyone for joining me, and have a great week, and we'll see you next time.